companies right now are in a downsizing, cost-cutting mode. Most companies, especially in the retail industry, have cut their expansion plans down to zero or cut them dramatically. Many are just looking at their own portfolio and suggesting that they should be looking at the bottom 10 or 15% and figure out ways to get out of those liabilities or change how they're doing in those stores. And so our services help them analyze their portfolio and help them determine which locations are working and which aren't, and then help put a plan together to go out into the marketplace to find either a replacement tenant or discuss with landlords opportunities for downsizing or getting out of leases, and for owned properties looking at ways to find a new buyer for the property. And it might be local, regional, national, or even international these days. A review of the lease portfolio is first and foremost. It has everything to do with the economics of how a location might be doing, and then you have to look at a particular marketplace. You may have a specific locations in a particular marketplace. 5 aren't working, 1 is, but doesn't make sense to close those 5. Then the cost of keeping one location open in any given marketplace becomes too expensive. So what we help do is go through that analysis, then determine what the market is for that particular location, determine if there might be another user, whether it's a similar type user or an alternate type user, to go in and take over the space. And then lastly, we'll approach landlords and see what their willingness is to renegotiate. Usually it comes down to the situation of the client. What is their economic situation? In truth, the better a client is doing, the more difficult it is for them to renegotiate terms. The landlords today have their own problems, and if a client is a tenant of theirs, has the ability to pay, and they feel comfortable that that tenant can pay, then they're not interested in negotiating. And it takes more creativity, and it takes going out into the marketplace and working hard to find a new replacement tenant for that location. Once you have that in hand, negotiations with the landlord become easier. So outsourcing of these types of services, although a self-serving comment, we always find works far better. Companies generally have relationships with these landlords, ongoing relationships. Maybe a retailer is opening stores in a mall that a particular landlord owns, and to pick up the phone and say, hey, we need to get out of 4 locations, that landlord says, hey, you want to get into my new mall that we're opening, you can't close those 4 locations. Outsourcing it to a group like ours, where we have credibility in the marketplace, people know that when they get a call from our group that we mean business, that there needs to be a transaction done. Oftentimes the clients that we're working with are in a restructuring mode, maybe considering bankruptcy, and when we tell them that we need to get out of certain locations or a bankruptcy might result, that's the truth. And our team has 26 years of experience in showing that. So when discussions with landlords, when they speak to us, they recognize that they should really pay attention and see if there's an opportunity where it's not really win-win, but it's better than a losing situation across the board. So the real estate market today, it's trying times. As I mentioned earlier, companies are in the downsizing mode, and so to get a transaction completed, you need 2 sides to the coin. So you need a buyer, you need another party who's willing to play ball, and so finding other parties who are not also in a downsizing mode, who are looking to expand, who are looking to take on more leasehold responsibility, becomes more challenging. You need to be aggressive, you need to find alternate users for particular types of property. It's challenging. You need groups who understand how to do it, because old days real estate, brokerage, where you put up a sign and wait for the phone to ring, that's not going to get it done in today's marketplace. You need aggressive people who have relationships in the marketplace, who understand how to complete a transaction, recognizing that buyers in today's marketplace have lots of choices they didn't have 2, 3, 4, 5 years ago. In general, our compensation is success-based. The transactions we work on are anywhere from straight brokerage to investment banking capital raise transactions, and they may entail retainers or fees earned throughout our process. But the bulk of our compensation is success driven. When we complete a transaction for you, disposition of a property, mitigation of leasehold liability, sale of your business, raising money for your business, whether it's debt or equity, then we participate in earning a success fee for that transaction. In general, we'll compete in situations against middle market investment banks around the globe and real estate brokerage firms. On the restructuring bankruptcy transactions, many of the larger firms have not entered that arena. Typically, fees are condensed a little bit, and there's an understanding of the bankruptcy process and code that takes really years to understand. We have I'm an attorney by background. We have 3 attorneys in our group, in the real estate group. So we have years of understanding the bankruptcy code and how that relates to real estate transactions in general. What I can tell you is on the bankruptcy front, there has been a drastic increase in bankruptcies recently, and I can give you a few statistics. In the first 5 months of this year, the number of public companies that have filed for bankruptcy is up over 50% from the first 5 months of last year. For the 12 months ending March 31st of this year, so from March 3107 to March 3108, bankruptcies across the board are up just under 30% from the prior year, and corporate bankruptcies are up about 40%. So the more restructuring bankruptcy situations, the more assets there are on the marketplace. The issue that we're finding, and a challenge for anyone in the marketplace today, is whether there's equity in the underlying real estate, because so much real estate has been over leveraged, and we're seeing that in the home building industry in particular, that when you look at a project, you start doing some due diligence, you realize that your property might be worth a good amount of money, but it's a fraction of what the debt is on the property. And then they're sitting down with the bank and figuring out, what do you want to do? So we are definitely seeing an increase in foreign investment and foreign interest in the U.S. From our group, we have 1,800 investment bankers around the globe, and the last couple of months we have been getting more calls from our partners overseas representing people interested in acquiring properties in the U.S., and it's across the board. It's anywhere from large commercial tracts, shopping centers, raw land, industrial space. But what's interesting is, my sense is that they're still leery to pull the trigger on those deals, and they recognize that the economy here is favoring them and currency rates is favoring them, but still I get the sense that they don't think that we've bottomed out yet, and they're sort of waiting till they get that sense to jump in. And I think when that starts to happen, there's going to be a flurry of activity, because all the foreign investors are now going to see their competitors overseas now delving in the U.S. on a larger scale, and I think at that point potentially a boost then for some of the companies in the U.S. who are looking to sell assets, and now where there may not be that many people interested in buying some of their assets, obviously more interest, more competition increases purchase price.